This is the second part of this demand and supply series, part 2, where we look at the interaction of the two curves and equilibrium conditions. Price is determined by the interaction of demand and supply. Equilibrium is reached when buyers want to buy exactly the quantity the sellers want to sell, i.e. the market is cleared. There's no products or services left in that market. Here's a graph. You can see that the demand curve goes inversely, an inverse relationship, and it crosses here in the middle with the supply curve. And as you can see here, the equilibrium price that will be charged is PE, and the quantity demanded will be QE. As I've already indicated, equilibrium price, and that's the important thing, that's what we're tracking here at all times, is PE, the equilibrium price, at the given quantity demanded. Now let's look at a situation where we have a surplus in the market. That's when a price is charged above PE, in this case P1. Let's examine this. If price is charged at P1, you can see that at the higher price more suppliers are willing to supply that product, but at the higher price consumers, us, are unwilling to pay the higher price. So if we then draw that line from where it crosses the demand curve and the supply curve, you can see that Q2 minus Q1 is the amount that we have in surplus or an oversupply in this market. So what will happen in reality is that retailers, if you like, they will see that they have got too many items on their shelves. They will drop the price in order to move some of the excess stock, and as the price drops, more people are coming into the market who are willing to buy it at that particular price until it reaches back the equilibrium point PE, and this is assuming nothing else has changed from the conditions of demand or supply. Let's look at another situation where we have a shortage in the market, where we charge a price P1, but this time it's below the equilibrium price here, and you can see that consumers are really happy to buy at a lower price. Right? But at this lower price, suppliers are saying, well, look, I'm not making so much profit, I'm not able to cover costs, I'm going to reduce production, which then creates this difference, Q1 minus Q2, which is what we call a shortage. What will happen in this case is that buyers, sellers will see that their products that they produce are all selling very quickly. They'll notice that, and they'll push up their price in order to take advantage of that. And as the price is pushed up, less and less buyers will be in the market until the market is cleared, which again means that there's no excess supply or demand in that particular market. So let's track a change in equilibrium. What happens here? Let's assume that we have a decrease in supply. So that means that one of the factors or determinants of supply has changed. For example, we may have had an increase in wages, for example, which has made the cost of production more expensive. So what's happened here is that the equilibrium went from PE, or E1 if you like, to E2 at a higher price but at a lower quantity. This is what happens when we look at the determinants of supply. You can see here by looking at the determinant of supply, if it increases, there's movement in the existing curve and increase in quantity supplied and so on. Okay, for productivity, if that increases, it makes it cheaper, therefore an increase in supply. If there's a decrease, like you saw a little while ago, an increase in wages, for example, we have a decrease in supply and so on. I'll leave this up for a little second. Here we have a similar table for determinants of demand. When the price changes, we have a movement along the existing demand curve. Now income, if that increases, we have increase in demand, and so on. Tastes increase, we have a rightward shift increase in demand. You may want to pause it and have a closer look at this slide, but I'm going to keep going. Here we have an exercise where you can have a quick look at analysing how the demand or supply curve will shift. Now again, I'll ask you to pause and work through each one of these 8 scenarios in each one of those markets and see whether you can track whether there's been an increase in demand, a decrease in demand, increase in supply, or decrease in supply. Now we come to part 3, some limitations. There are some assumptions of this particular model which have to be outlined in order to make sense. There's a large numbers of suppliers and buyers in a market, but no one can influence the price. So everybody's a price taker and no one is a price maker. Now that's not always the case, but that's what we assume. So no one can adversely affect the price. The product is the same, okay, so we don't have differences in computers or foods or anything like that. It's all the same, so we can compare apples with apples, as it were. Everybody's got a knowledge of the market and no one's got competitive advantages. Again, it's simplified to make it easier to analyse and strip away differences, if you like, in order to track a change in demand, supply, which then has impact upon price. Perfect mobility, so you can change from one factor production to another. So what are some conclusions here? You can realise that most of the assumptions are unrealistic, but it's like any model that you create. I mean, a model aeroplane is not going to fly, but it will show you the basic principles of how it might fly. Almost all markets operate in imperfect competition or perfect competition, and in that way, really, demand and supply analysis is limited. But as I said, it's important to show major changes, so you can track the changes. And this is a Latin term called ceteris paribus assumption, which means you look at one factor at a time, everything else is being equal.